Welcome to Don't Retire, Graduate, the podcast that asks you what you want to be when you grow up so you can graduate into retirement with purpose and passion. I'm your host and valedictorian, Eric Brotman, and this is Office Hours, where we answer listeners' questions about personal finance, retirement readiness, and more. We received a question from Emily, who asked, how does the 2022 market correction compare to prior market corrections, and what should investors do? And Emily, isn't that the big 500-pound question that we're all dealing with here? The reality is that the correction this year is based on factors that are unique. And there's this tendency to believe that anytime the market corrects, or there's a bear market, in fact, that it's different this time. And I'd like to share with you that I think, yes, the facts are different, the reasons are different, but I don't think our behaviors or reactions should be different. So the prior corrections, the most recent ones, were in Y2K. So when March 2000 hit, there was a giant market correction. And then the great financial crisis in 2008, 2009, when markets dropped in some cases as much as 40 to 60%, depending on the type of asset class and type of market, in like 6 weeks. So this 2022 correction has been a little more gradual, but it's also been significant. So what do investors do? Well, it depends a little bit on you, Emily. If you're 25 years old, 35 years old, 45 years old, and you're adding money to your 401k or other savings vehicles or investment vehicles, and you're doing this every paycheck or every month, and you've got it automated, don't stop doing that. And the reason I say it is you're getting an opportunity to buy securities, the same securities you wanted to buy in the first place, but you're able to buy them on sale. You're able to get a discount on them. You know, I've often joked that the stock market is the only place where people feel like if there's a sale, something's defective. A sale on towels at Macy's used to have a line around the door on Black Friday, but a sale on Wall Street, people think something's wrong. The reality is this is now a supply and demand game, and people are going to continue to see downward prices as long as there are more sellers than buyers. Once people decide that the bottom is near and start buying again, we will see a correction at some point. I don't know when that's going to be. I don't know if it's going to be next week or in 3 months or in 2 years. I'm just a firm believer that at some point, particularly equities, there will be some recovery because there are earnings. And when there are earnings, there's a reason to buy a security. So for you, if you're 25, 35, 45, if you're adding to an account on a regular basis, keep doing it. If you're 55 to 65 and you're contemplating retirement or graduating into retirement in the near term, you want to treat some of your assets with kid gloves. In other words, you want some assets that are relatively secure, but you're liable to still be buying. You're in your peak earning years. So in the accounts where you're buying, keep buying. In accounts where you're holding, meaning you're not adding to these accounts, be a lot more conservative in those spots because you don't have the same opportunity to buy low. Now, if you're 65 plus and you're either fully graduated into retirement, or you are moonlighting, or you are consulting, or you are just sort of at the tail end of your career, you might be in a spot where you're going to start withdrawing from your portfolio at some point. For people withdrawing from their portfolios, the biggest thing that can go wrong is withdrawing from assets that are at-risk assets at a point in time when they're deflating, when they're losing value. We don't want that to happen. So segregate your assets. Have one account or more than one account that is extraordinarily secure. Cash equivalents, short-term bonds, boring. But have 5 years or so of a runway, so that you know where your income is going to come from those accounts without worrying about what the stock markets or real estate markets or other markets are doing during that period of time. If you do that, it will allow your other assets to stay invested and to stay in some form of growth security. And so, Emily, you asked a great question. How is this similar? It's similar because we've got fear now. And when there's fear, the fear will drive markets down until greed takes over. And fear and greed are like a pendulum for investors. And when that occurs, as soon as greed steps in, you will see a massive buying and you will see the market go the other direction. So I know I haven't answered your question specifically. I don't know enough about you to advise you. But as a general rule, If you're a buyer, keep buying. If you're a holder, make sure you're being a little bit more thoughtful about the level of risk you're taking. And if you're a seller, take basically no investment risk on the accounts from which you're withdrawing, or at least segregate part of that account to make sure you're protected. So I hope that helps, Emily. Great question. I'm glad you asked it. If you'd like to ask us a question, which we can answer in a future episode of Office Hours, post it on our Facebook page or tweet us at Brotman Planning. I'd like to thank all of you for listening. We'd love to hear from you. So please send us a message or leave us comments at don'tretiregraduate.com or on social media, or leave ratings and reviews on your favorite podcast site. If you enjoyed the show, share it with your friends and family so they can join you on your journey to financial freedom. Thanks for coming to Office Hours. We'll be back next week with an engaging guest. For now, this is your host, Eric Brotman, reminding you, don't retire, graduate. Don't Retire, Graduate is part of the Evergreen Podcast Network.
Securities offered through Kestra Investment Services, LLC. Kestra IS. Member FINRA SIPC. Investment advisory services offered through Kestra Advisory Services, LLC. Kestra AS. An affiliate of Kestra IS. Kestra IS or Kestra AS are not affiliated with Brotman Financial or any other entity discussed.